Okay, welcome out to the halftime report presented by tackletrading.com, August 20th, a Monday morning. Markets are mixed here this morning, Matt, but generally kind of the same attitude that we finished the week on. How are you doing this morning?
Doing fantastic, Tim. How are you doing?
Incredible. Always opportunity. Lots going on in my life and also in the market. S&P 500 is pushing resistance again here at 2858. And you have a little consolidation there. I'm looking for the potential for a breakout. Now, the last two breakouts did not have a lot of carry through on them, Matt. If you look at the breakout there at the end of July, it was two candles, then back into the moving average. And then in the beginning of August, two candles back into the moving average. What are your expectations? What's your read on the market here this morning?
I'm not taking anything from the read of the market this morning. It's a very, very, very laid back day in the market for a Monday coming out of the weekend. But that's kind of to be expected with the Jackson Hole meeting coming up later this week on Thursday, Friday, where basically the central bank, as well as economists and scholarly people, academic type people, meet in Jackson Hole, Wyoming. I believe this was started under Bernanke a few years ago. Yellen continued it. Now Jerome Powell's continuing the Jackson Hole meeting every August. And out of that meeting, they're not looking to make any policy decisions in this meeting. They might discuss it, but this meeting is more academic driven. It's more, a discussion, high level economics, monetary policy around the world. But you also have the Fed meeting minutes coming up on Wednesday of this week. So, I think with the Fed this week in kind of line and not a whole lot happening from a geopolitical, you're just having a very, very loose day in the market.
Yeah, loose and kind of mixed. Facebook is down, Microsoft is down, Apple, which has been a juggernaut, is down. But then you've got strength in materials and a lot of good airlines, kicking in.
Airlines breaking out.
This is what I call stock pickers market, Matt, because there's opportunity if you go in there and you start digging into the individual companies on your watch list.
Well, there's also not only on the bull side, for the first week in quite some time, I found quite a bit of opportunities coming into the week on the bear side as well. And I think that goes in line with what you were talking about. This is a stock pickers market right now. Instead of, the entire index kind of just driving in unison with one another, you're finding unique opportunities in different sectors, different industries. And that's why it's so important as part of your weekly routine to analyze those sectors, Tim, to see what sectors are doing good, what sectors are setting up, what sectors do you feel are breaking out versus retracing, so that you can always go where the money goes.
Yeah, for sure. Let's take a look at all the different major indexes, work through our market skyline, one step at a time like we always do. The S&P is first. Let's go to the Dow, the NASDAQ, and the Russell as well. Dow Jones has been playing catch up here recently. In fact, it's had a lot of strength. This week in the market, the Dow breaking out, already confirming that on Friday, Matt. This is more follow through. Relative strength in the industrials, and that might be a little bit of sector rotation happening in this market.
Mm-hmm. Well, yeah, we've talked about it, about the Dow. Yeah, I love how you put it, the Dow playing catch up, and the Dow has been playing catch up ever since really kind of the first of the year, when the Dow got absolutely smashed back down into its 200-day moving average, when it's found its footing here. And we make fun of Gartman a lot, but since Gartman kind of made that call that the Dow could see, 30,000 by the end of the year, the Dow's up about, what would that be, about 500 points since that time period. So you're looking at the Dow playing catch up. It's breaking out of its resistance level. The one, and I don't want to put rain on the Dow's parade here, but I'm not really loving the breakout, to be perfectly honest, Tim. I see resistance here pretty strong at 25,800. That's kind of where you're approaching right into this level. I think you could see a little bit of fade action before it ultimately breaks out. I think the breakout of 27,800 is a little bit more important than the breakout of 28,650 that we kind of gave that. So you're kind of coming into a little bit of, I would call it intermediate resistance. I wouldn't say it's something that, is going to stop something in its tracks by no means, but just to keep that in the back of your mind. Yes, the Dow is breaking out. The NASDAQ, the RUT, the S&P are not yet. However, you are sitting at a fairly significant resistance zone right now.
Yeah, some resistance overhead. There's no doubt about it. Dow Jones has had better strength in the last few days, but I don't like the breakout either. I'm very cautious about a breakout in the S&P. It doesn't mean I'm going bearish. What it means is that I'm going to continue to stock pick and run my portfolio and balance things and all that kind of stuff. You got to respect the strength. You have to respect any breakout. Doesn't matter how weak it is, you know. But I do think there's some caution there. And really, part of my caution, Matt, is in technology. The fact that tech has been the leader of the market for so long, and now is, you know, not showing the same kind of strength that the other two have been showing. How do you interpret the fact that tech is down the last week while those other two are up?
Yeah, it's hanging out. It's partying. It's post earnings. Let's take a break type mentality here. I'm not buying into any type of rotation out of tech yet. Okay, so it's not showing some strength on a breakout. The Dow is, but if you give me the Nasdaq versus the Dow, I'm taking the Nasdaq right now, and I'm taking it tomorrow, and I'm taking it the next day. I still like the technicals here. I still like the trend here. I still like the pattern here. If you'll see, on our trend line that we drew a few weeks ago, you still have a very consistent trend line. You're currently sitting at that trend line right now. You're looking at a type of cup and handle type formation that is kind of happening here, where you have the cup and then the handles kind of forming here. And the cup and handle formation, Tim, is a very consistent consolidation pattern, which basically ends a previous trend and is the beginning of a new trend. So when I'm looking at this pattern, even though the Dow is showing strength the last 3 days, especially against the Nasdaq, I like the trend. I like the pattern on the Nasdaq. I'm not buying it yet in terms of the index, but like you said, I think you got to show some caution to the indexes right now and be a little bit more of a LeBron James cherry picking type player, where basically you got to go find some stocks in those indexes that are setting up and play the stocks a little bit more aggressively than you're playing the actual indexes right now. But ultimately, I do expect the index to break out. And when the NASDAQ breaks out, we know exactly what the NASDAQ can do. It's very similar to the Russell 2000 in that capacity, where when the NASDAQ or the Russell breaks out, those things have a tendency to run faster than, say, the Dow Jones or the S&P does. And like you said, it's not that I'm discounting the breakout in the Dow. I certainly see the breakout in the Dow, but to me, it still has so much overhead resistance, and there's still so much that is going up against those companies versus some of these tech companies. I still like the trend and pattern a little bit better here, even though I'm a little more cautious.
You know, if you're out there and you are here live, that means you're part of our halftime crew, hashtag halftime crew, and welcome everybody. Give me a quick thumbs up and a like. And as we go through the market conditions, one quick thing, young Cam, I don't know if you're still watching this or not. Matt, when our Zoom videos pop up, it goes over the candlesticks on the top right of the chart. Do we need to problem solve that? I mean,
I don't know what that is. What are you talking about?
Like when our webcams grab and it shows on YouTube, like when I'm talking right now, it covers 7382 there in red and a couple of the candlesticks on the top. What we may want to do is detach your Thinkorswim just by an inch and drag it from right to left.
That has to be something on your NT. I'm not seeing it. It's not coming across on YouTube.
C'est la vie. All right. Okay. Let's go to RTY, the Russell 2000. I've been talking about a potential breakout here for a long time. We've actually made a lot of jokes about, that triple top, Sarah top, whatever it was that we called it.
Source or something like that. I forget.
Yeah, triple toposaurus. I think that you've got the potential for this big breakout. And there's a lot of different storylines that could go into small caps, Matt. Now, one thing would be the fact that you don't have as much international trade exposure for some of these smaller companies. They are more dependent on just U.S. economics in some regards, not all of them, obviously. But here's a simple one. Before the consolidation, the Russell was the best performing index of the year. This whole thing for the last 2 months could simply just be a time correction as the market was waiting for the potential for a breakout and a run. It's not showing me that this morning, but I'm very interested in small cap strength if we catch a breakout.
Yeah, even with the consolidation over the last couple of months, Tim, it's still one of the best performing indexes out there around the world, not just in the U.S. market. So, it's taken in this happens. We've talked about this in the past when we were talking about high bases, right? A high base technical pattern is something that runs really fast and then takes a break. the Russell ran very fast throughout the spring and early summer months, and now it's just taking a break. It doesn't mean it can't run again. It's taking a break. It's catching its breath. Let it run again. The question is this breaking out today, or, as I've drawn this pattern here, this is what's called a symmetrical triangle pattern, connecting the tops, connecting the bottoms. It puts a lot of pressure on it to break out or down one way or the other. So are you buying this as a breakout today, or are you looking at these previous highs?
Mm-hmm. I don't know. For me, I'm probably looking at the 1720 zone. I don't think it's a breakout here. I'm not, even if it is by definition, which you could claim that, a breakout into 1700 zone flat, and then you have a 1705, you have a 1710, you have a 1720. I think you got to get a breakout on the long-term weekly chart, Matt. This has been a 2-month consolidation, bringing it into this compression. I'm not going to micro focus on the decimal point. I'm going to look for volume and carry through on the candlestick. It's going to have to be a big picture candlestick here.
Well, if you look at this on the weekly chart, you're seeing kind of an ascending triangle situation, and that's kind of what I drew here. That's kind of how I'm looking at this pattern here. I'm not looking at it from a symmetrical triangle perspective. I'm looking at it from an ascending triangle perspective, and the difference is significant. The difference is, if you're looking at it from a symmetrical triangle, this is a breakout technically. If you're looking at it from an ascending triangle situation, then it is not. That breakout situation would be that 1720 level. And if you're playing it as that, this is still just neutral. And that's how I'm categorizing right now, is just the Russell 2000 is neutral right now. I still have, bullish positive one on the S&P, bullish positive one on the NASDAQ, bullish positive one on the Dow Jones. I am neutral on the Russell 2000. But if it does break out as 1720, and you're looking at this from a weekly standpoint here, Tim, a breakout of 1720, closing above 1700 on the weekly perspective, I would take that as ultra aggressive if it closes on the weekly above 1700.
A lot of potential. There's no doubt about it. I like the Russell to potentially move up the board. Right now, I still have it down on the list, Matt, and ranked a little bit lower. But like we've been saying, if you catch that breakout and confirmation, I might shoot it way up the list.
I'm still straight down the list. I'm still NASDAQ, S&P, Dow Jones, Russell 2000.
Yeah, not a bad call until we get further information. Now, let's go over to the market skyline page on tackle trading. I know that we have a lot of people use Thinkorswim, and we love the charts here, but there's some sector stuff I wouldn't mind flipping through over there. And guys, really in the chat here, type in daily routine, because a lot of what we're doing here is just repetition on what we do as a daily routine. Here in the market skyline, Matt, we've got all the different charts set up. Let's start with the heat map and just tell me what you see as, that heat map comes up here on the Trade Center. Maybe click skyline next. Yep.
Yeah, I got it.
Okay. So mixed market is kind of what we started with, Matt. You do have strength and weakness.
Well, you got strength in services, you got strength in basic materials, you got strength a little bit in drug manufacturers, but for the most part, you got more neutral type situations. I'm not seeing a whole lot of weakness outside of Intel, but outside of Intel, which I'm bearish on semiconductors as a whole. I think they're all prone for a reversal type situation. Outside, it's just spotty. I think the biggest thing that stands out to me today is the price movement in basic materials. Your price movement in the major airlines, Netflix, Nike. Those things are what I'm looking at today.
Yeah, I'm looking here. The big cluster is obviously right in the center, Home Depot, Lowe's. And I know Lowe's has earnings coming up this week. Netflix, you had mentioned in our preparation for the show here today. We're going to talk about that stock here in a minute. I like the materials sector showing some strength in general, although there's been weakness there. I like a mixed market. I have no problem with this. This is a very typical market for a stock trader to come in and say, okay, there's opportunity as you go up and down. As you come down here into the indexes, Matt, there's a few extra ones I want to look at. Bitcoin, kind of sitting down there at that 6,500 level. Emerging markets are still generally in a downtrend. There's no question about it. Volatility is still boring. There's nothing going on with that one. Let it go. All right.
At what point are you just to admit that looking at the volatility index is the most ridiculous thing on a daily basis.
That's just a flesh wound, Matt. There's no
It's not
way
a
I'm
flesh
ever
wound.
good.
It is literally the most ridiculous thing. You had habits back when you were a kid that you don't do now. I mean, and I'm dead serious. At what point, when you realize something is no longer useful, do you stop the routine?
Well, I haven't gotten to that
Because you have
point.
to evolve.
I haven't gotten to the point where I don't think it's
Really? Because at no point in the last month we've been having this argument on the VIX have we ever spent more than 1 second looking at the VIX. And at no point has anybody ever said anything that is relevant on the VIX or has helped anybody decide any trading strategy. So again, at what point do you just say, we don't need to look at the VIX every day?
Well, I don't know. I mean, I think it's almost now just a nice little comedic reminder of how fun it can be
The
to have
VIX, the
disagreements.
VIX
I
is
don't
going to
know.
be nominated for Clown of the Week. That's what's going to happen.
We'll have to get some different opinions on there. I know Tyler actually still thinks
Yeah,
there's
I
value in
read
it.
Tyler's definitional blog that didn't lay out one argument about why the VIX is still viable.
Say la vie. The commodities market, the dollar is down on a pullback, though, Matt. Every Forex trader I know is going to be interested in this pullback. The Forex report over the weekend from Coach Noah at Tackle Trading was fantastic. And a lot of the analysis was, hey, guys, we're waiting on this price action to come back and correct. You do have a
I'm waiting
correction
to
here.
pounce on the dollar. I
Yeah.
am waiting to buy the dollar against almost everything out there. And, for those of you that missed the breakdown in the euro, for those of you that missed the breakdown in the pound, for those of you who missed the breakdown in many of the currencies out there last week, we're setting up for a really good retracement, Tim, on the dollar against some of those other pairs out there. Looking at the euro dollar here, Tim, you're seeing a retracement come back up into the breakout channel at 115. I would love that as a shorting opportunity on the euro dollar pair. You're looking at the pound dollar here, same type of setup, huge increasing momentum to the downside, consolidation. Look for that to retrace back up. And, if I'm drawing my trend lines here, I'll show you kind of the channel I'm looking at it to kind of hit it. It's right into that channel right there, somewhere around that 1.27 to 1.28 level. I'm looking at that from a potential shorting perspective. You're looking at another one I love here, setting up fairly aggressively. The Aussie dollar versus the Aussie dollar pair. You're looking at a breakout channel right there at, that was a terrible trend line I drew there, not horizontal in any capacity, but you're looking at somewhere around the 73.30 to 73.50 mark as a resistance zone. That's retracing back up into that level. You're looking at the not the CAD, that's kind of all over the point. Swiss francs all over the point. I wouldn't touch the Japanese yen dollar pair. Basically, I'm not looking at touching any safe haven currency against the dollar here.
Go
And that
back
would
to the
be
CAD for a minute, though.
yeah, but very quickly, that'd be your Swiss franc and the Japanese yen. I don't think you should touch any of those currencies against the dollar. But in terms of the euro, in terms of the pound, in terms of the Aussie dollar, those things are all setting up for potential shorting opportunities. You were looking at here at the dollar CAD pair.
Well, and not from a technical perspective, because I'm with you, but from a fundamental perspective, if oil weakens and the commodity sectors weaken, I do think the dollar CAD would break and run, dollar strength CAD weakness, because it's so dependent on commodities.
No, I agree, but and I mean, Tim, what you're really kind of setting up here this week is long dollar, short commodities is what you're looking at this week. I mean, you're looking at the dollar retracing, coming back down, looking at the dollar index very quickly. You're looking at the dollar coming back down into your breakout channel of 95.50. And then you look at this from a commodity perspective. I mean, my goodness, Tim, outside of crude oil, just look at some of your precious metals out here. Palladium retracing back up into resistance while the dollar is coming back down into support. Platinum doing the exact same thing. And looking at your other precious metals here, silver retracing back up into resistance. Gold retracing back up into resistance, showing some strength. We said this last week. You watch those gold bugs. You watch that as the gold gets back up into 1,200, maybe even up to 1,210. You watch the gold bugs come out there and say, hey, listen, we're back, we're back, we're back. And then the shorters come in here and just drive the price down. I think you're setting up for a short precious metals, but it's not just that, Tim. I'm seeing weakness. I'm seeing bearish retracements in a lot of the grains, a lot of the other commodities out there as well. The only two commodities that show potential buying opportunity, well, if I would say three commodities that, out of all of the commodities, three commodities that really kind of have buying potential right now is oil, sitting at the 200-day moving average. I probably wouldn't do anything until Wednesday with the oil inventory report, but that's sitting at the 200-day moving average. That's screaming to a potential buying opportunity. You're looking at natural gas here as well. Natural gas sitting in a high base type situation, showing some strength, looking for a potential breakout of three. I would not buy the breakout of three at three, but I'm just seeing a potential strength in natural gas. I'm seeing a reason. You can make a justifiable reason to pick up oil at the 200-day moving average. But when you're looking at the dollar coming back down into support, when you're seeing a massive dollar bull market right now, these are unique opportunities that I don't think you should miss. And so what I'm looking forward to is long dollar against the euro pound Aussie pair. And then I'm also looking at shorting the precious metals as well.
Yeah, bring up FXI if you would. One of the major storylines I was reading about in almost every different website I went to this morning as part of my routine was the overall China and US trade negotiation and their talks. I guess they have some kind of summit or meeting later in the week, Matt. I don't know what kind of resolution we're going to get from that, but there's optimism in general.
It's a low-level meeting. I mean, this story we'll see 100 times in the next 300 days.
Yeah, that's where my head is. And so as the headlines kind of sweep in and out, and companies like CNBC and Reuters and any other news organization, they're going to focus on explaining it in the simplest way they can to explain the market that day. But I don't think we have any more clarity on how we're moving forward.
Those headlines meant nothing to the market, Tim. They meant absolutely nothing. Are you kidding me? The market knows we're going to have these conversations. The market knows it's up and down. CNN and all the other media conglomerates out there simply try to give a headline a reason why the market did something good or bad. Whether that's actually accurate usually is not the case. And again, I don't like getting into the fake news, no news, good news, bad news, all that jazz. But the simple reality is they don't understand why the market's going up or down. They just have to give it a headline. Sometimes they're right and sometimes they're wrong. It's not a matter of being fake or not. It's just a matter of skill set, and they don't possess it.
Yeah, yeah. And then another one of the major storylines, and actually go to Forex Factor, let's take a look at the calendar. I want to talk about that Jackson Hole Summit meeting and the Fed. And then there's a link. I'm going to pop it in the actual chat here in Zoom for you, Matt. The countdown to the September meeting is on the docket, and they are going to raise rates. Talk in general about this time of year with the Fed. This has now become an annual meeting with this Jackson Hole thing. Does it create any news? What are you going to be watching for? Give us.
It creates a tremendous amount of headlines out there. I mean, both this week during the actual summit, next week. I mean, you will have overreaction everywhere Monday through Sunday on this one, right? the analysis, the overwhelming, and it basically what it is, it's just a bunch of rich bankers getting together, drinking wine and eating fancy cheese, talking economics. Me and Bobby call that a bottle of bourbon, but it's that's all they're doing, Jim. They're just having a conversation. This is not a policy meeting. This is a party, is what it is. And so basically they get together, they discuss economics, they discuss world cycles, they discuss interest rates and economics from around the world. I'm sure they're going to be discussing U.S. raising interest rates. What are the other major economies, major central banks out there doing? Should they continue? Does the economy justify the aggressive interest rate hikes, if you want to even dare call that aggressive interest rate hikes? God, I really believe people do not understand history in any capacity when they think Jerome Powell is an aggressive hawk. He's not. He's neutral. He's raising interest rates in a very moderate perspective. But coming out of the last 10 years, any interest rate hike is obviously seen as hawkish. So they'll be talking about, the plan, inflation, unemployment, all of that jazz. I'm sure there'll be economists around the world come in to lay out papers about the emerging markets and whatnot. What I'm looking at is, does the emerging market crisis that we are seeing develop around the world are the central banks around the world worried that that could cause some type of negative influence on the major markets out there? And if they are concerned about that emerging market crisis, are they more or less willing to come off their aggressive stance on the interest rates? So, the U.S. economy justifies an increase in interest rates. I don't care what Donald Trump says. It absolutely justifies increasing in interest rates. If not, be prepared for hyperinflation 15, 20 years from now. So in terms of the US economy, it does. But if you're looking at the world economy, I'm not sure the world economy can take an increase in interest rates, and a strong dollar will continually put pressure on those emerging markets as they're trying to find their footing. Can that lead to something bigger down the road? Absolutely. So that's what I'm looking at coming out of the meeting is are they willing to look at that emerging market crisis to justify or alter their interest rate policy?
Well, I mean, you hit it right on the head because this year's kind of keynote topic is changing market structure and implications for monetary policy. These Federal Reserve bankers, Matt, they really are academics in the strictest sense. They want to put out peer-reviewed articles and have that become, cited journals that impacts the way that academics look at these kind of problems. But really, the news headlines is what's going to affect the market. And we know that in September they have another meeting coming up at the Federal Reserve. The FOMC is going to be raising interest rates in September.
Tim, this is much more of an academic summit than it is a monetary policy summit.
Yeah.
And you're absolutely right. They're out there. I'm sure they'll be discussing their papers. I'm sure economists from the IMF will be there, from the World Bank, from the ECB, from the Bank of Japan. I'm sure they'll have, basically, there's a great movie that came out before Too Big to Fail. And I can't remember the name of it. Matt Damon was was kind of the narrator of the movie, Inside Job. I believe that's the name of it, Inside Job. If you have not seen Inside Job, or The Big Short or Too Big to Fail, these movies that came out, after the subprime market crash, I would say watch Inside Job. That is the best movie that kind of details what was happening, that led up to the crisis in the first place. But during that movie, they show, one of these policy statements, and it wasn't Jackson Hole. They didn't have Jackson Hole at the time, but it was at some type of policy summit where an economist from the IMF came out and warned them about what was happening in the subprime market bubble. And basically Bernanke just pushed it aside, didn't care about it. And that was literally like in September of 2007 or something like that. So I'm sure there's going to be economists come into this meeting ready to detail about what's happening from a world economic condition, about how we've repeated the bubble cycle of the 2000s and the 1990s, about how we're overinflated in price. I'm sure there's going to be that out there too. So, does these speeches, these, give them doomsday speeches, right? Does these speeches that come into these meetings, do they have an impact on Jerome Powell or any of the other Fed chairmen like Dudley out of the Bank of New York? Do they come off that aggressive stance they've had on interest? Because if they're projecting a world recession in 2019, 2020, and Tim, I'm certainly in that ballpark, somewhere later stages, 2019, 2020. So if they're projecting a recession in there, do they come off their aggressive stance and say, let's kick the can down the road? Those are the things I'm looking at.
First of all, that's like asking at a Republican National Convention if somebody is going to turn into a Democrat. I think they go into these meetings, they already have a stance that they have developed for 30 or 40 years through academic work and opinion and policy and all that kind of stuff. They're not going to change their mind.
Yeah, but Jerome Powell's still relatively new, and we don't know him. He's even relatively new to the Fed.
He probably knows himself, though, Matt. I mean, that's the thing. I didn't know Ben Bernanke when I first saw his name in phase. But Ben Bernanke has always been the guy that was going to do quantitative easing.
I knew who he was the first time he gave a speech.
The bearded one.
I knew that man was just an academic playing monetary policy, applying his theory to practical application, and he turned the world economy into a debt-driven society that's going to crash. So yeah, I knew that guy.
Well, speaking of which, I mean, we could transition into our major topic here today, which is going to be the longest bull market we've been in of all time. There's also some stocks in the news, Matt, that I want to take a look at, some earnings previews, and some companies on the pick list from the weekend that I think were really interesting. Where do you want to go next on this?
I do want to have a discussion because this is kind of driving me insane. On Wednesday of this week, many people are saying that this will be the anniversary of the longest bull market of all time. Okay. Now, I want to ask you guys a question out there. So for the halftime crew, is this yes or no? It's just a yes or no question. Is this on Wednesday going to now be the longest bull market in U.S. history? It's just a yes or no question. Many people say yes. Okay. Me, I say that's hogwash because they don't understand math, numbers, or history. Okay. So I just want to quickly summarize the debate here, Tim. That's all I want to do. Quickly summarize the debate. Now, Tim, a recession, okay, or a boom market, bear market, okay? Boom market, bear market, we're all talking 20% gains, 20% losses, right?
I think that's the standard definition. Yeah.
Okay. Mm-hmm. So if I come out here to a monthly chart on the S&P, let me change the time period, and I go all the way down here to max available. Okay. Now, the longest bull market in the history of the markets was the .com 1990s market, right? Mm-hmm. Now, some people will, and this is where the debate happens. Some people say that market actually started in November of 1987. Okay. So in November of 1987, we're coming out of the October, flash crash that we had in 1987, right? Black Monday. Mm-hmm. So was that Black Monday or Black Tuesday? It might have been Black Friday or Black Wednesday, Black Thursday. I get the Black Mondays mixed up sometimes.
Oh, it's always a dark day on Wall Street. Yeah, very.
It's always a black day. Anyways, yeah. Okay. Yeah. So in this month, you did see the market contract over 20%. It actually happened in one day, but you did see over the month it contracted over 20%. So that's the definition of a bear market. So from this point forward in December of that year, some people project that from December of that year through, I want to say it is the end of the .com run was this month right here, and that was in September of 2000. So that's what some people say. But Tim, if you recall, in 1990, we did go through a recession in 1990. Mm-hmm. And it was coming right after the Gulf War. George Bush was heavily favored after the recession. His favorability kind of took a hit. So if you'll look right here, from the top to the bottom of these 3 months here, you went over about 20%, about 25%. That is a bear market. So the beginning of that point starts in October of 1990. So October of 1990 is the beginning point of the .com market. That runs from October of 1990 until September of 2000, which equates to 119 months in terms of expansion. If you're looking at the current marketplace, and guys, I think you can make an argument that 2011 actually hit the number. It was like 19.8% or something like that. But most people, and so discounting this 2011 or summer 19% correction, most people project from March of 2009, the bottom of the market, to currently August of 2018, Tim, that puts us at 113 months, which means we're not approaching the anniversary of the longest bull market in all time. We're still 6 months away.
Go back to the period between 87 and 90, or in 2000 again. And let's just look at that from that period on a chart. See, if the whole debate really comes down to how do you define it, right? Because the National Bureau of Economic Research, they don't define a bear market from a 20% correction on stock prices. They define it based on GDP having 2 quarters of retraction. And the NBER expansion date to, started actually, if I'm looking at this right here, 1990 in July to March of 91, they had a recession. So they started in March of 91 and they finished in March of 2001. It was 120 months. Mm-hmm. Okay. So I don't know.
Economics are slower than markets, right?
I get that. Yeah. I get that. So it just depends on how you define an expansion or a bull market or what the actual purpose is.
But we're also defining 2 vastly different things here. Yeah. When you're defining it from an economics perspective, you got to use GDP, right?
Sure.
So A recession is 2 consecutive quarters of contracting GDP. A depression is 4 consecutive quarters of contracting GDP. So you're talking about, at a minimum, Tim, you're talking 6 months to even determine what a recession is, versus, say, a bull market. You can determine that in days, not months, right?
Sure.
So from the Bureau of Economic Research, they're looking at just key GDP figures over the last 100 years. From a bull market, bear market, you have to look at bottoms to tops. And so from bottoms to tops, you're looking at October 1990 to September of 2000. When you're looking at it from GDP, you don't even track that till September of 2001, right? When the recession hit. But but my whole point, Tim, is if you wait till the National Bureau of Economic Research comes out and says, hey, this is a recession, everybody wake up, it's when the market is already down, right? So traders know the market cycle. Traders know what's going to happen. Traders price things in. So you don't wait. I don't utilize the National Bureau of Economic Research in defining bull versus bear. You use it in defining boom versus bust economic cycles, and they're just two different things.
Well, and the more I think about it, there's really four periods that I would want to compare and really think through the actual problem, because I don't care if one is 109 months, the other one's 111. That's a headline thing that, it's
Just something to talk
interesting.
about.
It's interesting. Same way stats in like baseball are interesting. I like to know who has the most hits of all time and who has the best, whatever. I like stats. I like
Zeros.
data. Well, Ichiro, if you count the Japanese
That doesn't
baseball,
count.
it
That's
does
a,
count.
you're at,
See,
you're
that's what I'm talking
analyzing two different
about.
things there.
They're both
You're being
professionals.
the National Bureau of Economic Research and not being the trader here. You're analyzing. Okay, I can't.
Let me pull it back and let
Yeah.
me ask you one of four periods. The
Mm-hmm.
great growth of the 1950s, okay, where markets were incredible in the 50s and early 60s, post World War II kind of area. You have the 1980s, Reaganomics, after they came in, cut taxes, threw money into the problem, deregulated Wall Street. You had the expansion,
Mm-hmm.
the tech bubble, and now. Okay. So those four different periods have had tremendous expansions, in different regards, in different ways. Which one is the most impressive? Which one is the one where you look at and you're like, this is the way that it's
I will
supposed
tell
to
you the
be?
two most, if I'm looking at all points of expansion since, say, the end of the Great Depression, right? Okay. And what you're seeing on your chart is those points of expansion. I think the most innovative and important for the world was the technological era, the great expansion, the introduction. And don't get me wrong, it's a close second for me with the 1950s industrial boom, right? So in the 1950s, you had a massive industrial boom in the U.S. You had a massive workforce. Women started coming into the labor market. The U.S. expanded its industrial production. They become the number one exporter in the world, number one currency in the world, number one economy in the world. And that was all based on what we did in World War II and the expansion that followed after World War II. So I'm not just cherry picking the 1990s because I was alive in the 1990s, but I just see the 1990s as something that has changed society to such an extent that we've never seen in history. I mean, everybody's lives around the world now revolves around this singular aspect of things we call technology, and even how we value companies has changed from the technological era until today. So when I look at the expansions, by the way, the expansion we've had in the 2010s, the so-called post-crisis bull run, I would rank that almost dead last in terms of not importance, but in terms of real true economic value, because the real true economic value that's happened in the last 10 years, there hardly is none. And I'm dead serious there. There is hardly no innovation in the last 10 years. It's all been driven through bonds and quantitative easing and cheap monetary policy, stock buyback programs, mergers and acquisitions, basically the free money parade of the 2010s. That's what drove that bull market. And unlike the new expansion, the new evolution, the new technology in the 1990s or the industrial production of the 1950s, we're basically building this on a house of cards today. So even though we are approaching the longest bull market in history, I certainly would not rank that in terms of overall importance to the world economic community as I would say the Great Expansion or the post-war boom.
I think for blue collar workers and for society, the 50s and early 60s set up a lot of where we are today. I might actually put that first. The
It's up there.
1990s, for me, it was one of the biggest changes in the way that you lived your life because before tech and after tech is like a completely different, you know, way of living.
I mean,
Quite frankly, there's no debate. Current one, Matt, is really interesting because we have had progression in medicine, we have had progression in a lot of different areas, but there's so many different questions that are coming from right now, whether or not some of those things are even good or not. And the nature of who's getting the wealth from this expansion, I still
well,
think
I mean,
has
you
changed.
mentioned healthcare here, and I'll certainly agree with that, Tim, that healthcare has seen expansion. There's no doubt about that. But I also see this as a negative, Tim, because healthcare, because of these cheap monetary policies, because of what happened with national healthcare and whatnot, the insurance industry and everything, healthcare is going through its evolution into 2010s that finance did in the 1980s. And in the 1980s, Tim, finance was a defensive sector. Finance was conservative. Finance was boring. Because of the deregulations of the 1980s, you basically created this monster called Wall Street, and they
Mm-hmm.
just basically took over like a juggernaut, right? And it became an ultra aggressive place where basically, nobody trusts Wall Street. You look at the healthcare industry right now, people who go into the healthcare industry, they go into it to serve people is what they do. That's what they go into it for, to serve and help communities and innovate and help human beings. But now healthcare is big business, big business. When the CEO of United Healthcare is getting a $50 million bonus on decreasing revenues simply because of Obamacare and national and insurance companies, that's a problem for me. So, when you say healthcare has expanded, I'm saying, yeah, but not necessarily in a good way.
Yeah. Yeah, more on this obviously as we talk. I'm sure it's going to hit the headlines as well. And frankly, I have no idea when the end is in sight, Matt. We've been talking about the end of the bull market since 2014. We have not seen it. One thing that we know as traders, guys, is that you have to prepare based on what you have in front of you, though. And when the market is at this height of a bubble, Matt, I'm going to start doing things like buying insurance, before there's a problem, hedging, staying balanced.
Well,
Part of when we go through the daily routine and we say we're a plus one. See, the reason I say that and why that's important is that tells me to do certain things in my portfolio to stay balanced and protected, right?
no, absolutely. But Tim, we're by my calculations, we're about 6, 7 months away from exceeding that all-time bull market in the Bernanke market here. Do I think it's going to hit? Yeah, I do. Look at the monthly chart here, Tim. You're
Mm,
breaking out off a retracement on the monthly chart. That is the strongest technical signal that we've had since way back here when you were breaking out of the 2015 neutral market coming into the election, and we saw price go up 20-25% the next year. You're seeing the same thing right back here when it kind of broke out of this ascending triangle in 2012. So, from a monthly chart perspective, from a weekly chart perspective, from a daily chart perspective, I still see more reasons to buy than reasons to sell. So, I don't think we need to get aggressive with insurance. I think we just need to go trade.
yeah, for sure. Bunch of stocks I want to take a look at here today, Matt. Pepsi was in the news, and they had some kind of acquisition of some healthy something. What was it?
You don't get into the healthy stuff. Is that why
I
you
don't
don't?
listen. Pepsi trying to be healthy is just crazy to me. I get it. I guess I should never tell somebody
Is
not
that kind of
to.
like the Saudi Arabian investment group trying to buy Tesla? Is
It just
what's an oil company doing,
like
right?
one of these things doesn't fit here, obviously. But Pepsi's trying to go into the health craze, I
SodaStream.
guess. Soda
SodaStream's the name.
Stream, whatever. Well, I mean,
Listen,
here's the thing.
SodaStream, Tim. SodaStream goes back to 1903. Did you know that? 1903.
Well, all right. So
It's a UK company.
if you order, yeah, I've always, this has always been a question I've asked from around the world, around the globe, and also around the country. When you order a drink from a waitress at like a
Can it
diner,
be a waiter? That
what
was
do
kind
you?
of sexist.
Sure, might have been okay, but
I'm kidding.
how do you say it?
Can I get a pop?
Soda, soda pop,
No,
pop,
I don't say any of that.
Coke.
First of all, I say, can I get a lemonade?
Did you
That's what I
know
say.
that this is the actual great debate that we need to have in this country, Matt? People have
I've seen this on
disagreed
social
on
media.
this.
Is it pop or soda, whatever,
Or soda
whatever.
pop or
I'm
Coke or
out.
whatever it is, you're out.
I'm
I
out.
actually like soda. I use soda. So soda pop being around since
I
1900
just
doesn't
don't say either
surprise me.
one. I say Coke or Pepsi, or I say the brand.
Well, it's
Sprite.
not moving the needle on the stock price either. This kind of thing where the headline you go and you take a look at it, but there's nothing going on here. $3 billion acquisition you would think might move it more, but it did not. Usually in an M&A deal, Matt, the person paying the money will drop in price. It's usually a negative story for that company.
Well, it's not
Pepsi
cash
didn't
flow.
drop. Yeah.
Well, yeah, I mean, they got a pretty decent deal on it. Paid 10% above market cap on SodaStream for $3.2 billion. It's a muted response. This is what tells you the market doesn't really care about it. It's the volume. It's not necessarily the price action doing nothing. There's just no volume here, right? It's just like, all right, another merger, another acquisition, another $1 billion. Let's move on.
Yeah, bring up GREK on a chart. I wanted to get your take on this one as well. Several years ago, Greece almost went through an entire bankruptcy from the country. They almost got tossed out of the EU. Today, it was in the headline that they got out of their bankruptcy program, and they're now somewhat moving
They
forward, and
can
they don't
now
have as many
tap the
restrictions.
financial markets for funding. Wow, I can't wait to see how far Greece goes into debt now.
Yeah,
I know they bitched and moaned about those austerity programs from Germany years ago, but Germany is trying to get their debt under control, and they're loaning out billions of dollars. So did the finance minister figure out why their debt problem is so bad? I mean, did this last 5 years? Because I still see Greece in the same percentage of debt than they historically was. They've just repaid some of their bills by borrowing against other people. So
sure.
yeah,
XLRE was a sector that we've been highlighting and focused on for quite some time.
sucker
XLRE
just wants
now
to move, baby.
is just running like
It's
crazy,
just
Matt.
running.
What's your read on this? Is this a profit taking zone for XLRE if you're long?
Well, we prep this trade, and that's why you see the lines here. It's at our target based on potential average yield. It's overextended based on its own average cycle, but you gotta love the momentum going into that target, though. I
Mhm.
mean, a lot of times when you're looking to lock in profit, it's a doji type small base candle at a target. This is showing strength going into it. You're at the top end of the range. If we start to see some intraday weakness, I'm going to start locking in profit. But outside of that, Tim, you got to love the momentum going into it.
A lot of what's happening on my charts recently has been a rotation into key sectors, and real estate has been one of them. Another one has been XLP, Matt, consumer staples. And this is retail week, and there's a lot of consumer companies on both discretionary and staples and just retailers in general that we're going to be paying attention to. This is another chart that's just been really strong.
It is, but I would stay away this week on
Mhm.
this one. There's no reason to get out of that, in my estimation, the real estate one. But when you're looking at just a couple bouts of earnings here, and I'll just read a couple: TJ Maxx, Kohl's, Urban Outfitters, Lowe's, Target, Gap, Ross Stores, Foot Locker, all announced earnings this week. You're
Don't miss
looking at
Baba, Tackle 25 stock, $400 billion company. That to me might be the key earnings of the entire week.
yeah, Bob. I don't know. Are they necessarily a retail like Ross though?
No, I mean it's more like an Amazon.
Yeah.
Go to Baba because this one to me I'm going to be paying really close attention to. Baba's been on one of my favorite stocks for a long time. One of yours as well, Matt. I think it might have been in the top 3 or 4 companies on the Tackle 25 performance for the last few years.
Mm-hmm.
And if you pull that thing back to the weekly chart, this is where my head's at on Baba. Because the earnings stocks, I'm going to play them. I'm going to watch them. I'm going to be fascinated. It's a $400 billion company. What a $400 billion company does, I'm going to have more interest in than, say, like a $30 billion retail company. Nothing against the other
Well,
company.
no, I agree with you 100%, Tim. I think Bobbitt obviously is much more important than anybody we just listed. But if you're looking at XLP here, Okay, we were looking at it from a trading perspective. We nailed this kind of this bounce off 53 upward movement price. For me, if you're looking at a very similar outcome to the real estate and to XLP, I'm locking in profit on XLP and I'm not getting out of XLRE. And the reason I'm a little more cautious on XLP, Tim, really doesn't have anything to do with BABA. It really has to do with the dearth of the retail earnings as a whole. But also you're starting to see slowing momentum, right, on XLP versus increasing momentum on XLRE. So what I was talking about with XLRE is exactly what we're seeing here on XLP. Short, narrow body candlestick, that gives me pause for concern. You couple that with the amount of earnings we have coming up this week in retail. To me, it's an easy stay away on for the week. If you nailed this retracement, it's time to lock in profit on that.
Yeah, I got no problem with that. And as we look at the overall earnings landscape, obviously August is not a busy time of year. A lot of these companies, they report specifically because their industry competitors are reporting at the same time. Like we've always said, guys.
And that's why, guys, you always see tech getting reported in 1 week, finance in another week, healthcare in another week. You obviously have a conglomerate of different sectors, but they typically report all around one another.
Go back to BABA, though, because I got a hypothetical question for you. Yeah. And I want you to pull it back to a 3-year weekly chart. This thing is on major support, Matt. And the other Chinese companies have broken major support. If we look at FXI, the overall index for China, it is in a downtrend. We even were talking about the potential that it's moved into a bear market. If BABA missed, gapped down, and got crushed, let's say hypothetically, and we don't know what direction it's going to go, could that actually confirm the bear market internationally?
Heavens, yes.
Yeah.
A company like BABA, I mean, the entire Chinese market's down over 20% already. BABA is one of the saving graces in the international community. I mean, you look at just some of the stocks here in the U.S. You got the VIPs. Look at the VIPs. Look what's happened to the VIPs ever since the tariff discussion. We've talked about this many, many times in the halftime report. How this trade war that we're in, and we are in a trade war right now, but this trade war we are in right now has had a greater impact on the international community, China, and those emerging markets than it has the U.S. so far. You're looking at the VIPs. The VIPs has been slaughtered since the tariff discussion. You look at Baidu here, okay? Baidu, very similar to what you're seeing in Alibaba, coming down into major support level. You look at BABA here, showing weakness, and I'm missing one of the major Chinese stocks. So if you think about it,
Tencent, TCE.
Yeah, Tencent. So Tencent is what? It's TNCHY.
TCEHY.
TCH. Say that again.
TCEHY, like a mutual fund. They got 5 letters. Not many stocks.
Stand 5 letters. Every one of them. Tencent, Comcast, drive me nuts. Okay, that should be like, if you go 5 letters, you should immediately get shorted. That's how that should be. But you look at Tencent here. Tencent down from the highs to the current price, down 16 points off 60. I mean, that's down over 20%. So if you're looking at some Chinese stocks here that are major, Baidu's sitting on a major support level right here at 220 with the 200-day moving average and at $200. You're looking at BABA here, similar type of technical setup, major support here at 170. Either one of those I kind of like at those levels. And the reason I do, and I'm not talking about from a swing trade perspective, Tim, I'm talking about from an investor perspective, because, and the reason I like it, even if you're like, well, I don't love that chart, here's why I like it. You have cheap risk. And what I mean by that is when you buy a support and you have a stop loss under support, you have cheap risk, right? So if you're wrong on it, you don't lose that much, versus if you wait, you don't have cheap risk anymore. So, I'm looking at Baidu, I'm looking at BABA from an investor perspective. Obviously, this goes without saying, but we have to say it in the world of disclaimers and litigation. You don't look at it before the earnings. You wait till after the earnings perspective. Earnings coming up later on this week. Market maker move on BABA is expected to move right around 10 points, which is about 6%, Tim.
Yeah, and we'll revisit this on Wednesday,
Oh, I'm sure
Thursday
we'll have a
morning.
trade on BABA.
I'm sure. I'm
Yeah.
actually looking at Splunk. Go to the option report and get my analysis on that SPLK for a bi-directional trade, but it doesn't come up till later in the week. We'll take a look at that one tomorrow or Wednesday. A couple of different stocks I want you to get your take on. DocuSign, which we looked at in detail last week, DOCU, triggering nicely, and obviously it's
That's why
moving
you watch
up
the
on the
halftime report.
chart. Yeah.
That's why you come here on a daily basis. That's why you pay attention. That's why you treat this as a business. Tim, and I'm just going to say something very quickly. I'm willing to bet the people that come here on a daily basis are more consistent than people who don't. And I'm willing to bet people who treat this as a business are more consistent than people who don't. I'm willing to bet people that do their daily routine on a daily basis are more consistent than people that don't. People miss trading opportunities when they don't pay attention, right? This was a great trade setup. You nailed the trade setup. And now to me, it's too late. It's too late to make this trade if you're not already in it. Because if you make the trade today, you don't have a reward to risk ratio than you did last week when you made the trade. So it's important to apply that on a daily basis. Nothing to see. It's a great trade setup. As it's approaching 62, that's from the buyer side of it. That's the only thing you got to worry about is at that 62 level. Secondary target, I think, is a previous high at 66.
There's about 7 or 8 stocks that I think are trigger entry types from this weekend's reports. I'm going to have you guys go check those out. Just go watch your reports. There's two areas in general that I want to talk about here. Just get a quick take from you, Matt. Airlines breaking out, showing strength. ALK is my favorite right now, but DAL also right behind there. I like the potential reversal and pattern there on ALK. DAL has probably a clearer path on resistance and showing a nice breakout here. Airline
I have
strength.
not read the news on the airlines today. I'm going to have to go read that, but all of them doing really, really well. 2 of the airlines were on the stock report stock and options report this week, ALK, Delta. All of them were approaching resistance. American Airlines, I kind of like the potential reversal on American Airlines here as well. So if you want to pick up cheap, you look at American or you look at Alaska. And if you want to buy into strength, I think you look at Delta. But either way, you got to love the price movement that's happening on the airlines right now.
Sure. Delta, Hawaiian Holdings, JetBlue, American, Alaska, Spirit, United Continental, and Southwest all up relative
All
to the
showing
overall
strength.
market. Yeah, but out of those, I think you've nailed them. And then the last one, and I think it's become a mandatory segment of the day, is Tesla, TSLA. JP Morgan downgraded them, came out and said, listen, and this is going to be more fallout from this, Matt. The way financial institutions and big money work and the way players in this business work, they're going to slowly start to move away from Tesla based on a lot of the recent things that have been happening. Would you agree with that?
I'm just going to say what took them so long.
Yeah.
It took me about 5 seconds to realize that was a lie. And I don't understand why it's taking anybody else so long. There's so much smoke here. There's so much fire here. And there's so much SEC probing here. I am shocked this company is still even $300. Whoever's buying it off. And I said this last week, Tim, when they were buying it off, when they were buying the intraday, I was like, who in the hell is buying this? I mean, seriously, who in the right mind with all the smoke that's around Tesla right now is coming out and saying, oh my God, I think this is a good valuation at $300. I mean, that it's utterly insane to me that somebody is picking this up right now. And I could be dead wrong on this, Tim, and Tesla could find support at 290, bounce up, and Elon could have his funding secured. And, the oil conglomerate out of Saudi Arabia could save the day. Or JP Morgan, who came out today and said, we're lowering our price target down to 195. And we thought this private, funding secured would be a lot further in the process than it was. Again, Elon lied, and the faster and the sooner we all admit it, we can get on with our day. But the reality is, I would not touch this with anybody's money right now. I just want to.
Twitter is a very fascinating social media, and it's interesting. If you use it correctly, I think Twitter can be an incredible resource. I've really enjoyed, getting more active on Twitter myself. If I'm a board of director of these major companies, I might want to tell these CEOs, get the hell off Twitter, or even if
If I'm the board,
Yeah.
I am finding every time a CEO tweets, I'm finding them.
Aye, aye, aye.
But if I'm the board, as a consumer, I love the transparency. I love Mark Benioff when he comes out there and retweets and tweets. I love Elon tweeting. Elon, please tweet more. It gives us more fodder. But as a board of directors, I'm like, oh my God, you are the risk. I mean, think about him as a bi-directional trade. He is the ultimate risk and he's the ultimate return. If he's right, Tesla changes the world, right? If he's wrong, Tesla goes to zero. So, for me right now, I don't short Tesla because I just don't. That's just not in my DNA. I do believe in Elon Musk. I think he made a mistake, and I think we can accept people who make mistakes. But I still don't understand why anybody would own this stock right now. I don't. There's too much risk.
Well, somebody owns it. He owns a lot of it, actually. He's the number one shareholder, I believe. And then you've got all those institutions. It is the most shorted stock in the market, Matt, I believe, by percentage of allocation. I'd have to look that up to
Like
confirm that. But
30% short
it's
float.
really high short interest right now. It's a very heavily shorted company. Company has a lot of opinion around it. We talk about it all the time for a reason. Same thing with other traders. I'm expecting bi-directional movement. Matt, when it was at 370, I said, hey, bi-directional. We don't know where it's going to go. It's down 70 points.
We've been saying the only way to play Tesla is straddle, 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 strangle, strangle, strangle. That's the only way to play Tesla right now is on both sides of the angle.
Well, that is
How would
exactly right.
how would he respond if he knew that you could both short and buy the stock at the same time? Would he be like, "Wow, that's mind blowing"?
Well, first of all, he already knows everything. So what do you mean if he knew? He already knows everything about everything. He is a super genius. And
I just changed my stance. I'm shorting Tesla right now.
and
Here's the
boyishly
fanboy.
handsome. And
Here's the fanboy. You get those baby blue eyes out there. Let's go hang out in the Black Rock Desert. Let's go do that.
oh,
Right.
my favorite
Whatever.
part, he did some interview. I didn't see the interview, but
I
somehow he
don't
was
believe he
talking
works
about
120 hours a week either.
he had to like confirm that he wasn't stoned or something like that when he was
He
doing
was stoned. No, I don't know
it.
if he was stoned or
Uh,
not. I have no clue about that. And by the way, I don't care if Elon Musk gets stoned. That doesn't bother me in any capacity. I don't care one way or the other. What I care about is Elon Musk sent a tweet that said he had funding secured. He did not have funding secured. That is obvious. That is market manipulation. And it's no different than when the people he hates on Wall Street, it is no different when they do it versus when he did it. He lowered himself to what he sees as a problem in society because he wanted to troll them and have them lose money. This was a game played by billionaires against billionaires, and I think Elon took it too far.
Yeah, and guys, here we are Monday morning. We're done with our halftime report. A couple of key bits of information to do's. If you've not seen the scouting reports from the weekend, remember Monday's always a good time for it. On the stock and options report, Matt, I already found 6 triggers this morning myself on trades that I
Tim, I
took.
got 15 trades I'm looking at making this week off those stock and options report.
The stock and options report are full of good trading ideas where there's video and write up. Go watch those, go see those. If you don't know what I'm talking about, go sign up for Tackle Trading and find them. Second thing is, Matt, we've got a lot planned right now. And one thing that we are going to start, in fact, we got a guest on our podcast here soon, is the Bear Market Survival Guide, which is going to be a premium system we're going to be releasing at Tackle Trading. More information to come. What can you say about that right now?
Very excited, very excited. A lot of development's been going on the back end with Tackle, with our premium systems, personal gold, bear market survival guide, cash flow condors, those types of things. Also development in terms of our Tackle trading on demand series and whatnot. But Bear Market Survival Guide is a video-based on-demand program that teaches people how to protect their retirement accounts, their stock holdings, and then go out there and make money as the markets go down. And obviously we talk about the US markets in it, but you got to realize there's always a bear market somewhere. There's a bear market in the emerging markets right now. There's a there's potential bear market, not potential. There's bear markets in commodities right now. There's bear markets in certain sectors right now in the stock market. So when you're learning how to the bear market survival guide way, that can be applied not only on your 401k and your IRAs, your retirement accounts, but your individual stock holdings, your commodity holdings, whatever it is. It's a great system. We're looking to put on a webinar, Tim, on, I believe, is it September 6th or 5th?
5th. It's going to be a Wednesday, Sep 5.
September 5th. So everybody mark your calendars, September 5th. Tomorrow or the next day, we'll have a landing page with the registration so that you can sign up for the webinar and all of that jazz. But we're very excited about this.
Yeah, quite frankly, I think it's game changing for a lot of investors out there to have these kind of tools. So we'll talk more about it tomorrow. Thanks for being here, guys. Halftime crew, as always, give us a
like and share.
And a share and a comment is great. Thanks for being a part of Tackle Trading. We'll see you tomorrow. Mm-hmm.